The American monetary system, a complex and dynamic framework, orchestrates the creation, circulation, and valuation of money, sustaining a $150 to $200 trillion economy. Its historical evolution, from the localized banks of 1791 to the centralized structure under the Federal Reserve established in 1913, reflects a response to the inefficiencies of diverse, counterfeit-prone banknotes. The first bank of 1791 introduced fractional reserve banking, enabling money creation through loans and standardizing currency, while the Federal Reserve Act resolved the instability of the 1836 to 1913 period, expanding the money supply to $20 billion by 1913. The 1971 shift to a fiat system, ending the gold standard at $35 per ounce, provided flexibility to support a globalized economy, culminating in a $21,560 billion money supply in 2025. Fractional reserve banking drives this system, allowing banks to create money through loans for real property, like the $48,200 billion real estate sector, and consumables, such as a $1 bubblegum purchase. These loans generate $20,400 billion household debt and $21,600 billion business debt, fueling transactions that produce $5 trillion in tax revenue in 2024. The Federal Reserve, setting interest rates at 4.75% to 5% in 2025, manages this process through bond purchases, supporting the $45,560 billion federal debt and stabilizing markets. The U.S. Treasury complements this by printing currency, combating counterfeiting, and collecting taxes, while issuing bonds to fund a $1,900 billion deficit, ensuring economic liquidity. The dollar's value, untied from gold, depends on global trust, with $8 trillion in foreign reserves, but faces risks from inflation and market fluctuations, as seen in the 2008 housing crisis. The Federal Reserve generates revenue from securities interest, fees, loans, and foreign currency investments, funding operations like $1,100 million salaries and remitting excess to the Treasury. Operating within a $100 to $115 trillion global money supply, the Fed's revenue practices are critical to maintaining stability. This system, while complex, adapts to modern demands, balancing growth with reliability. Future challenges require vigilant management to ensure the dollar remains a trusted cornerstone of global finance, supporting economic prosperity and public welfare through a robust, evolving monetary framework. Addendum: the evolution and projections of the U.S. money supply. The U.S. money supply, a fundamental component of the nation's economic infrastructure, has experienced significant growth since the inception of its formalized financial system, reflecting the expansion of economic activity and monetary policy innovation. In the pre-1791 period, the monetary base was modest, estimated at $10 to $15 million, consisting primarily of physical coins and notes issued by local banking entities. The establishment of the First Bank of the United States in 1791 initiated a structured increase, with the money supply reaching approximately $20 billion by 1913 following the creation of the Federal Reserve. The transition to a fiat system in 1971, moving away from the gold standard valued at $35 per ounce, facilitated greater flexibility, elevating the money supply to $21,560 billion in January 2025, encompassing cash reserves, transactional accounts, and savings instruments. Historical data illustrates a steady progression, with the monetary base growing from $4 trillion in 2000 to $21 trillion by 2024, indicative of robust policy responses. A notable acceleration occurred between 2020 and 2022, when economic stimulus and central bank interventions added approximately $6 trillion, raising the supply from $15 trillion to over $21 trillion. Economic analyses suggest that nearly 60% of this total has accumulated since 2008, expanding from $5 trillion in 2002 to $20 trillion by 2023, driven by measures to support economic stability and growth. Looking ahead, the future trajectory of the money supply warrants careful consideration. The rapid expansion, surpassing the economy's productive capacity, raises questions about potential inflationary pressures, as observed in price adjustments during 2022 to 2023. Projections indicate that a return to pre-2020 levels might require a reduction of $3 trillion, a significant adjustment given the $45,560 billion debt burden in 2024. Alternatively, a modest contraction, as suggested by a negative growth rate in 2023, could signal economic recalibration, with a 3.9% annual increase in 2025 offering a measured outlook. Supported by $8 trillion in foreign reserves, the currency's global position remains robust, though ongoing monitoring is essential to maintain its value amidst international economic dynamics and domestic policy shifts.